Okay, good morning, everyone. My name is Brian Cox. A lot of very familiar faces. Oh, this is kind of neat. Can we turn the volume down? It sounds a little loud, at least to me. Okay. Okay, and so this is a carry-on to work I've done now for 12 years of this stock portfolio. And we have been trading this as a group. We have a trading group that gets together once a month, and we're all partners in this trading group. And so we've been trading this specific technique for 12 years, and this is going to be talking about that and comparing it to how SPY performed. Okay, myself is my education. I have a Bachelor's of Science in Electronic Engineering, plus graduate courses in computer architecture and artificial intelligence. A financial trading experience. I've been buying stocks since 1982 through 2000. That's of course when we had the big stock crash, and I've also been buying or doing trading options since InvestTools and Thinkorswim in about 2004. So I've done options, I've been buying stock, I've been doing a little bit of everything. Okay, and today is I'll be sharing the performance of the Lizard stock portfolio through the pandemic, actually, post-pandemic. The portfolio is a stock club partnership that meets monthly basis. We're now doing this all virtual. We used to do it face-to-face. What I'm discussing is representing actual trade results, and the trading philosophy I will discuss as I talk about this. Okay? The specific techniques have been talked in other presentations, and you can click on this link to get into a folder that has a much more depth discussion of each of the ways that we trade. And then in the end, again, we'll compare the Lizards portfolio versus the SPY portfolio. Ken has it.
It's available on Ken at excessprofits.com right now, and the video for this whole presentation will also be up on our website.
Yeah. And in particular, if you need more background, go to this link when you bring up the presentation. Click on that link, and that'll go over to a folder with a lot more detail about how we trade. Okay?
Brian, I'm going to have you stop for a second because we are not recording. We need to be recording.
Okay. Okay, and of this table that you're seeing, the stocks that we currently have active are the top stocks here, and these stocks are ones that we have stopped out of. And so this is of the last 1 or 2 years. So you'll be able to get a sense of what kind of items that we've been trading. We usually trade things that have had growth in the past of 150 to 200%. And if you look at those at least when we traded them, had that kind of growth. Okay, and so how we manage the portfolio is we continue to meet and trade once a month. We've been meeting virtually, pretty much following the sequence below, which is that we review each of the positions, looking at the charts, and determining if it's time to move up stops. Because essentially what we do is we just keep on putting in trailing stops, and when a stock hits that stop, we sell everything. Okay. Then, as a group, we discuss any new candidates. We look on a 2-year time frame with the TOTS charts, and if the stock has potential, we look at the stock in a stock plotter at charts.excessprofits.com, and that's just another way of looking at the stocks. And that was a tool I built. And if we want to include it in the portfolio, then we buy a position based on constant risk. And again, that's discussed in more depth in that folder But when we buy stock, we're buying a set amount of risk. And as we move up a stock, we buy more to keep that risk constant. And so it's a constant risk approach. Then I've never seen anyone else approach it that way, but watching other presentations, I realized that if you can't control risk, you can't control your profits. And so I control my risks every time I enter a stock. Okay? Then we also look at stocks that we want to move the stops up in position one, and then we determine if we want to buy more stocks or buy more risk of that stock. And then we also have additional rules that limits any one position to less than 20% of the value of the portfolio. We don't want any one position to swamp out all the other positions. So we make sure that we don't exceed 20%. And if, because the stock has gone up and it exceeds 20%, then we'll sell a little bit, get the cash, and then put it in somewhere else. Okay? And so this is a typical way that we put on the charts. I call these things fish bones, because when you start looking at them, they look like fish bones. And so this is a Thinkorswim chart, and these black lines represent our support, and the red lines are where we put the stop based on that. And so you can see at this point when we bought this position here, we call this 3 stops, or three positions down from where it was, and then we put the stop 2 ATRs underneath that. And we keep that stock in place until we move up the stop again, and then we move up the stock again. And just so that we can see clearly, I have these things called fish bones, which point to where we had the resistance at the time and where we had the stop at the time. And so you see these little fish bones growing as you go along. So this is a typical way that when we look at the stocks, we're looking at these.
You said you set your stops at 2 ATR?
Below the support, yes.
Okay, so you determine the stop by looking at the graph?
Correct.
And what kind of
Beth, we want to try to hold these questions to the end. Okay.
Okay. And so here's the Lizards' performance over the last 13 years. Now the main thing I always look at is the chart, and here's the actual gains that this chart has. And so you can see our compound, if we look at the end of last year, our compound annual growth over 12 years was 176%. It's okay. You know, if you get 15% per year, you'll double your money in five years, I think. And so in this case, we're a little bit below that, but at least we're not losing money. You know, some years are worse or better than others. Okay, but if you take this, and again, this represents us meeting once a month, 5 people. You know, it's not just throwing at a dartboard, but it represents some kind of work. And then along comes, here's SPY doing the same thing over the same years for the same 13 years. And we have 103 or 110 compounded growth. And so it's like, why are we doing so much work? And so just as a comparison, you can beat yourself up and get decent results, or you could do something else and maybe get better results. And so this is just a comparison, a long-term comparison of what we've been doing. Okay? And so let's just do a quick comparison. You have those 2 charts, but if you do the comparison, let's see. There we are. If you compare the 2, you can see again, here's the Lizards' 12-year compounded growth, 176%, or we've got 310% by just buying and holding SPY. And so just a quick summary, you know, is that the Lizards, we continue to meet monthly and follow those trading rules. It's, you know, become a social thing more than anything else at this point. But my personal trading is that since I retired, I just don't have time to trade. You know, you think you could have all this time, but no, I'm too busy doing other things. So, you know, I've checked with my financial guy. before I retired, he said, "You're good." I said, "What do you mean I'm good?" "Well, if you live to be 95 years old, you'll still have money. So you're saying I'm good." And so, yeah. So because of that, I'm not trying to, go for home runs anymore. At this point, I'm just, trading and getting what comes back to me. So my personal trading is outside my managed IRAs, which is my whole retirement. I have a large position in Tesla and a large position in SPY. And so I've gone from complicated option trades to just essentially buy and hold. And that's my story. I'm sticking to it. And any questions, or are we at 10 minutes?
1 minute.
1 minute. One question.
So, why not get this fire, go home and go to the beach?
That's what I tell my friends at the Lizard Club. I said, why don't we just buy SPY and then we'll meet up for dinner? And so, why not?
You can buy out of it.
Yeah, exactly.
One more question. Yes.
You can do all sorts of things with Tesla. I have just bought and held. I have no protection on it at all. I don't even have a stop on it. And so that goes against all my trading rules. But it's not a usual company either. I think it has a lot of potential.
All right. All right. Thank you very much, Brian. Thank you for thinking safety. Yeah, cool. All right. So Brian was one of the original people that got me into all of this stuff. He started this group in 2005 or something like that. It's been going on for like 20 years. So I really appreciate his efforts. So the agenda is I'm going to go next, and then I'm going to be presenting for Michelle. She's going to correct me if I make some mistakes. So my presentations are going to be a little quicker than what Brian's were, but that just gives you an idea of where we're headed. So, from the beginning, okay. So I'm an interdisciplinary engineer. I retired from high tech at the age of 48. So I've been trading for about 26 years. So I got to enjoy a really nice early retirement. Anybody retire before the age of 48 in here? No, not yet? Okay. I had one friend that did it at 38, but and he lived to 96. Trading style. So I'm willing to take a minimum loss. So you're going to hear some stuff from Jack, which is really cool, about his JSAFE stuff. But for me, I'm willing to take a $10 loss for a $100 gain, right? Or if I can keep it less than $10, I'll take it. Some of the trades I do are just like $1, kind of $1 or $2 losses, and then I get a good gain out of that. But I have to write special software to do that. But with age, I really want to minimize my downside risk. I'm 74 years old right now. You know, they say move more of your money out of stocks and into bonds and that kind of stuff. Well, I'm living with somebody that hits that home to me regularly. So my asset allocation is bonds. I got about 25% bonds and CDs. I have about, I do buy and hold. Jack, you're going to hear later, he got me into, he calls it a JSAFE trade, and got me into gold, and I'm up 20%. Really nice, cool, I like it, Jack. And then I have trading a section, which is basically 72%. And I go between trading and cash. I want to be able to get into a position really quickly, and I don't want to have to liquidate a lot of different things. So that's how I do my allocation. I was hoping the other people would tell how what their asset allocation was. Some people don't feel comfortable doing that, but for me, it's like I want to show. One of the things that's really cool about this group is I not only show the things that worked, but the things that didn't work. Things that didn't work, most people come back and say, hey, Ken, you could have done better. Like you heard with Brian, he's talking about the Lizards trades. Well, could have just bought SPY. Really good idea. So my claim to fame is a thing called a kStochastic. It triggers my active trading, and it's designed to front run all of the people that I learned from, the InvestTools people. So basically, before they get into a trade, I'm already in it. And then when they get into the trade, they got 10,000 of them. So what happens is that the price moves up really quick after that point. So I kind of like that. I don't know how many people in the room are using kStochastic. Anybody? Okay, a few people here. Okay, cool. And I use it for trading my Roth IRA, and I trade the triples, the SPXL, TQQQ, and TNA. And this is the. You're probably not going to see this on the internet, but this shows the trades for the TQQQ over the past year, and it shows the equity curve, and you can see the bottom one is the profit or losses of those individual trades. So if you look at a profit and loss curve, an equity curve, you see that if you did buy and hold here on the left, you see that there's these tremendous drawdowns. For my personality, it doesn't work. I do not like drawdowns. I hate drawdowns. And so, but for somebody that does dollar cost averaging, that's okay. It goes down, they buy more, and then it goes back up. I think that's a really bona fide way of going. However, when you use that with TQQQ, you can actually get really negative. You can actually lose 80% of your, if you had it all in that TQQQ, you could lose an 80% drawdown. I wouldn't go for that. You take $1 million and reduce it to $200,000. That doesn't work for my retirement. So I use the kStochastic. This is the results of the kStochastic, and it shows a minimum drawdown. And this is with compounded growth. So over the same period of time, this made about just over 100% in 1 year. The problem that I have is, see this one big spike here, this one big drop? That sucked. That was December 18th. I don't know if anybody remembers that date. That sucked. Well, it really messed me up on the TQQQ. I lost a lot. But on the SPXL, it got out at the top. So every one of them trades a little bit differently using my kStochastic, but on the whole, it works out pretty well for me. Other trading that I do, like I said, I do the JSAFE, the Jack is going to talk about here coming up. I trade individual stocks once in a while, and I do option strategies, verticals, iron condors, selling puts, and then buying calls and puts directionally. I'm not going to get into some of the really crazy esoteric stuff here. It's way beyond anybody here. I made one presentation at one of Jack's previous meetings, trading day of expiration options. It's wild. You can almost like gambling, but the returns are phenomenal. So the results, my net results on all my accounts. So I basically take everything I had over the past year, all my savings accounts, checking accounts, stock accounts, everything. I gained 0.5%. As long as it's positive, I'm okay for retirement. This is not great, but you can see that if I were to put all my money into TQQ with the kStochastic, I would have been up 100%. That doesn't happen because if it goes bad, I don't have recovery. So what I learned is I got too much experimentation. I spent a lot of time doing some of these other crazy little trades. Some of the trading is just way too complicated. I write software to minimize my complexity for my brain, but it takes a lot of work to write the software. Right, Richard?
That's correct.
So Richard teaches a class on TradeStation coding. So he's going to talk a little bit right at the end here, or see him if you want to learn more about TradeStation coding. Also, Michelle keeps on telling me, you got to get into more fixed assets. You got to get more fixed assets. You could have done a lot better. And so you're going to see what the results are of somebody that's got a little more experience than I have in some of this stuff. So other online resources. So you got excess profits for presentations, download the transcript, the ThinkScript code. So a lot of times, a lot of my code came from Larry Williams. Larry Williams said, hey, do a blast off. And he explained how to do the algorithm. I wrote it in TradeStation, and then I turned it over to Brian, and Brian took that and he turned it over into ThinkScript. And then I had the kStochastic, and I wrote that, and I tried to do it in ThinkScript, and then I didn't do very good coding. And then I turned it over to Tim, and Tim turned it around and made a really, really good implementation of the kStochastic on the ThinkScript. So it's a great community. Exit, and then go to Ken.Excess Profits for TradeStation code. It's all free available. Just download it. I'm not going to support it, but you got to be able to read the code. And then there's a YouTube channel which goes through all the different excess profits stuff. So if you go to that one at the bottom, you'll see, and just click, if you go to the one that's online, just click on it, and you can see all of the presentations that have happened before. So, quick question? Yes?
On YouTube, like the TQQQs, the triples.
Yeah.
And I haven't unpacked this for a while, but about 8 years ago I looked at that, and what I found is a real negative expectation when you go into the triples. A mathematical, you know what I mean, it's expensive. I found that they degrade because of the mathematical algorithms or whatever that are involved in it. And I want to ask you, when you look at, I like things that are for cheaper, you know, that are more expensive. I look at options. I don't like too big of spreads. I look at all that stuff, percentages. I want to ask you, between going with the triples versus futures, do you find?
So one of the members of our group, his name is Ed Stefan. So if you go back and look at the excessprofits.com, you're going to see the kStochastic applied to futures.
Okay.
And so that you'll see tremendous returns there, absolutely tremendous. My problem is every time I tried futures, I lose. It's a really complicated system, but I have a hard time with it. And as far as the TQQQ, if you just held TQQQ and it goes up and down, up and down, up and down, at the end, if the Qs would go up and down, at the end, TQQQ would be down. So it works great in the upward side. So if you can buy it on the upswing, that's what the kStochastic does for you. It gets you on the upswing. All right, so I'm going to go on to the next presentation here. I'm trying to stick to the schedule here, guys. And let's see who. Let me see who is going to be next here, real quick. Yeah, the one after the. I need to get this thing wired for some of the next person here. Hold on. No, Michelle. I'm gonna do it for Michelle here. Hold on a second. Agenda. Okay, Jack. Jack, can you wire yourself here?
Oh. You're gonna electrocute me?
Yeah, hopefully not. All right. Yeah, you're good. Well, Michelle, I'm doing Michelle's presentation now. You're going to be right after this. Okay. All right, and we're off here. All right. So Michelle has a finance degree. She's been in the investment firms for 43 years. She's got more experience than I got, all right? So she specializes in asset allocation. That's what the big guys do, the guys come in with $100 million or something like that, they asset allocate. So she's got a lot of this experience. Willing to throw down to $5 million on a stock trade. It's like, I would be shaking like a leaf putting the trade in. But she retired 1 year ago, and we met a guy who used the Tasty Trades thing, trade often, trade small, TOTS, right? So her asset allocation is basically, she's got small amount cash, 7% in trading cash. She's got some in buy and hold, and then she's got bonds. So bonds and CDs are what she basically keeps her money in. She keeps on coming over to me and she says, Ken, you gotta use something of that money. You got cash sitting there. You can't let it just sit there. Well, I'm gonna trade it. Well, and then a month or two later, it's still sitting there. It's not the smartest idea in the world, right? So she's sitting on my shoulder. I got one person sitting on my shoulder and saying, hey, this is a better way to do it. So I learned from everybody. Thank you very much, guys. So her trading style, she hates to lose on any trade. She's willing to hold and sell premium to recover. She has extensive use of fixed income for idle cash and most experience trading any stocks. You name the ticker, she'll tell you the stock. And right now we're using the kStochastic to find higher probability trades. So Tushar passed away this past year, and a little choked up about that. He showed us a technique about using it to find trading opportunities. He had this really cool scanning technique. And so what I did is I adopted it for what Michelle wanted to do with using the kStochastic. So that, like I said, Tushar was one that generated some opportunities. His software is still running. So if you can find the thing on the internet, you can actually still see his recommendations for what stocks to trade, what stocks to buy. He has a buy list and a short list, a long and a short list. So Michelle's also taking some option strategies right now. So now we're getting into a little more esoteric stuff, guys. Okay, so that's all the stock stuff. Now we're going to start moving into more of the option stuff here now. She takes small positions, TOTS, trade off and trading small, and she's using the kStochastic to enter the trades. We have a auto scan technique on the Thinkorswim platform. And all of her trading is done in a retirement account, either a Roth or an IRA, because it's a nightmare every year. Bill, if you see Bill Barmeister here, he'll tell you how tough it is to deal with all the different trading in a retail account and the CD worth of trades that you're going to be dealing with. It's a real nightmare taking it to the IRS. So trading style. Did that. Okay. So she's traded hundreds of trades in the last 6 months. Her maximum capital used was $20,000. The return on capital annualized is 40%. So you look at her trading list, and it's just a maze of stuff. And she's doing well. I can't knock it. Right? Cool. Just got to increase the position size. So other trading, so she's doing vertical, so she's doing option stuff, right? Verticals, selling puts, buying calls and puts. And then she's following Dan Kaufman. Don Kaufman.
You guys remember?
You want to get the microphone?
You remember Don Kaufman?
Yeah. So many people here know Don Kaufman from the early InvestTools days. He had an option trade that just ended yesterday, a butterfly and SPX. People know about that one? Gene, did you take it? She did. So I've never seen a trade where the price is up here for SPX and he's betting it's going to go over here with a butterfly. And I was like, why? I don't know. And so it did. It actually did. It actually went where he said it was going to go. She made 6 times on his money. He made 5 times. In the end, it could have been 14 times. But, most people are happy with 500% gain, right? Or in her case, 600% gain, right? So to me, it's amazing to be able to see somebody that can do that kind of a thing. Especially when you saw when he put the trade on, it did not make sense to me. So one of the things for Jack's presentation, so Jack's group does a lot more option stuff. And the San Diego Trader Group, so we got San Diego Trader Group, which does a lot of stocks and stuff. And then Jax does a lot of stuff with the options. So I'm gonna hopefully make a presentation on that coming up in one of the other follow-on meetings to your online meetings. So, really cool. So stretch goals, utilize the tremendous leverage of options, and start increasing the size of trades.
And that's what I need to do, is decide that I made the 40%, but it was not on a very large amount. So I'm working on increasing the size of my trades now, so.
Yeah, but between the two of us, she's retired, I'm retired, it's kind of fun. She's in one room, I'm in the other room, we just go walk from one room to the other room. Oh yeah, you just eat this one, oh yeah, John Kaufman said this, oh yeah, cool. Kind of fun, I'll tell you, it's a lot of fun. But the net income on all the accounts, after you take all of the pluses, all the minuses and stuff like that, is 5%. So it's not bad, it's like, okay, it's gonna get a lot better here coming up. So, any questions for Michelle? Yeah, Gene.
Okay, I was listening to Dr. Hodson before I came, and he was talking about the bonds going down.
Correct.
So how are you handling that?
I'm not doing any bonds. I have CDs that I do. But I have been watching everything he's talking about with the bonds. And that TLT, he's looking at, getting into that, yeah. But I do mostly CDs. I haven't done really any straight bonds. So, yeah. Fixed income is about it, yeah. Cash, money market funds, yeah, CDs, yeah. That's kind of what my fixed income is right now. But I did have bonds until it started going down.
All right. So this is Jack Bicer.
Hello, everyone.
You got your mic on?
Do I have my mic?
No.
No, I have to turn it on?
Yeah. Got it. Yeah.
Sorry.
Cell phone's off. All right. So slideshow. Current slide.
Yeah.
All right.
Sorry if my mother's in LA and if I get a alert, I may have to refer to my phone. Okay, so how many of you have heard JSAFE? Oh wow, cool. How many of you are doing JSAFE? Okay, cool. So JSAFE came about almost a year and a half ago, and I have done well over 100 JSAFE trades with real money, and I've been constantly working on improving it, even though the original JSAFE still works. Okay, and basically it's an insured trading strategy, and we expect to make a lot of money. It is the best way of that I know of building wealth sustainably and reliably. Okay, it's not the fastest way, but it is one of the most sustainable ways of doing it. So, again, standard disclaimer, I'm not registered. I'm not supposed to be giving trading advice. I'm not. This is educational purposes only. You can read the rest. I want to get to the real bone of things. So, Ken referred to risk, and to me, that's one of the most important things I look at in trading. For me, the main purpose of trading for wealth building is not to make a big profit. And you're going to say, Jack, are you crazy? We're all here to make money. If you don't want to make a lot of profit, what's the point of trading? It's not. To me, the most important part is managing the risk. Because I've been trading over 30 plus years. I've lost enough money to buy some real estate a couple of times. And what I can tell you is, when your strategy works, everything is great. But if you're not carefully managing risks, you can wipe out your account. So as I'm getting older, I cannot replace the money I made. So I have to watch it. I have to be careful. So what I try to do is manage the risk first, and then try to make as much as possible within that managed risk. Okay? So, and if you got a decent strategy and you manage your risk, your profits will make you a lot of money. And I'll show you a way on how to do that. So, the premise of JSAFE, the original premise, is when we buy a stock, we're usually taking more risk than a potential profit, right? The drawdowns could be big. JSAFE provides higher returns than the risk we take. That's the fundamental shift. For example, SPY over the last 30 years or so makes a little under 10% a year, okay? Even though it's done really well over the last couple of years. Even with that, it's about 9.86% a year. But SPY had a 50.8% drawdown. How are you going to feel when your money is half? Remember we had this saying when all the 401ks became 201ks? Okay, we lived through those times. I don't want to live through it. JSAFE turns it upside down. So basically with SPY, you're taking a $5 risk or 50% risk to make $1 or 10%. JSAFE turns it all the way around. You take $1 risk to make $5. Very different approach. So by managing the risk, I'm still making good money, but I'm not taking a big potential loss. Now, having said that, it doesn't mean you can't lose money. You still have that dollar at risk. So you have to be careful. Okay. So JSAFE itself is not a new strategy. Okay, the basics of JSAFE is based on collars, which is basically using a protective put and selling a short call. Okay, now it is my version and actually Jay's version. Jay here, let's recognize Jay. He's the original. He's the person who originally put that idea in my mind. We worked on JSAFE for quite some time. I do a lot of research on JSAFE and I bounce ideas off Jay as well. He is one of the best traders I know of. So, what is this is a slightly different version than what I have on the JSAFE.net site. By the way, this presentation a little bit more is on JSAFE.net. You're welcome to take a look at it. There's no registration, and it has been viewed by over 100,000 traders so far. That's just word of mouth. I don't do any advertising. There's no revenue there for me. So it seems to be resonating by people. But the basic version of JSAFE is, we buy a high growth stock. Actually, if you're ever interested, take a picture of this slide. There are two slides that are very good, and this is one of them. So we basically buy the stock. You're buying an in-the-money put. That's a little different. Used to buy at the money, but it's in the money put, 2 strikes above typically. Okay? So time frame, usually 6 months to 2 years, could be 3 months, depending on your time horizon. Then we're selling an out-of-the-money 30-strike call. So we have the stock, we have the protective put, and then we reduce the cost of the put. Okay? You can trade it till expiration, and as price goes up, you can roll up the put, eliminate the risk, okay, and actually lock in profit. So let me give you an example. So this is an example on Meta. There was a signal, and again, you still need to look at the charts. You still need to look for stocks that are supposed to be going up because you're still taking a small risk. Okay, here's an actual trade. We're taking, we're buying the stock at 344 and a change. 344, 350 is one up. 360 is the 2 strikes up. Okay, so we're buying a 2-strike put, and we're selling a 460.30 delta call. Now, the stock is 344. The put is extremely expensive because these are volatile stocks. At $50, you're paying $5,000, a lot. Very expensive. It's almost 15%. And if you just bought the put, like a married put, the stock has to go up more than 15% for you to be able to make money. So that's expensive, and that's why I like to reduce the cost of the insurance. And I do that by selling the call. And when I sell the call, I'm getting over $20 credit. So they're giving me this money. So my cost is about $30 on the insurance. Okay? If you want to calculate, and this is what really makes it work. I'm a very numbers-oriented guy. Numbers have to make sense to me. So I always want to know what's my risk, and I always want to know what's my max profit. Okay, so this is a little boring, but crucial information. So my max risk is $1,464. How do I calculate that? I take the cost of the trade, which is $374 and some change, right? And then my risk, my insurance is at $360. That's my put strike. So I take the $374, subtract $360 from it, and that's my risk. If you hold the trade till the end, you will not lose more than $1,464. It doesn't matter if there's a World War III. It doesn't matter China attacks the U.S. It doesn't matter if there's a meltdown in the U.S. As long as the stock market is there, you are protected. You don't care about gap down opens. You don't care about bankruptcies. You don't care about CEOs and whole entire executive team dying in a plane crash. None of that stuff, right? So stocks don't always protect you, but this put will, as long as the stock market is open. So how about the winning side? How much money can we make? Well, the calculation for that is very easy too. You take your call strike, which is 460, right? You're not going to make any more money than that. Your cost is 374. Subtract 374 from 460. That's your max profit. These are easy calculations, but they point to some very important facts. So my max profit is $8,530. Is it 30? 36, sorry. Okay, what does that mean? I'm taking a 3.9% risk to make 22.8% profit. Now, how many of you will be happy with the 20% profit? A lot of hands go up. How many of you will be very happy if your risk was only 3.9%? You're not taking huge risks, right? So basically, I always calculate my risk to reward ratio, and basically I take the max profit divided by max loss. So that gives me 5.8. So I'm risking $1 to make $5.8, almost $6. You see, with SPY, we want to make on the average of 10%, but we're taking a 50% risk. With a trade like this, we're only taking, let's say, 10% risk to make 58%. Right? So this is the fundamental shift of what JSAFE offers. And, for people who'd like to protect their assets, to me, that's one of the best ways of trading, okay? So taking the trades further, now I still have 3.9% risk, right? A $1,400 risk. Now, most of you, trading this size may be able to live with that. I don't even like a $1,400 risk. So what do? When Meta goes up, I take my 360, roll it up to 370. Okay? So that probably, I have to do the math, but if you add the extra premium and a reduction of max profit, then, this will probably take down my risk to maybe 2%. I do it one more time roll it from 370 to 380. What does that do? Take out the entire risk in the trade. Now I'm not trading with any risk. Maybe even locked in some profit. Isn't it wonderful to be able to trade with no risk in the market and looking at high returns? That's what JSAFE does. Okay, then let's look at another esoteric JSAFE. Okay, that's an F cell. So this stock was at the time trading for $1.44. What I liked about it is I could take the 1.5 strike put, and it was cheap, and 30 delta was at $5, right? So I put together a trade, and on December 19, 2023, bought the shares of F-Cell for about $1.44, okay, and bought the put at 57, sold the call at 15. My cost is $186. Almost anybody in this room can afford a trade like that, and of course we did multiple lots. So max risk is 36, max profit is $314. Okay, what does that mean? Risk to reward is 8.7%. Sorry, 8.7 times. So I'm risking $1 to make almost $9. Now guys, this is phenomenally good. Making 218% return ROI, right? It's a fabulous trade. Or is it? Pay attention to the next chart. Look at the chart. Okay? So the trend is down. No sign of sustainable up move. Just because the stats look fantastic doesn't mean you should take the trade. The chart patterns will always and always dictate whether you want to take that trade or not. It's not just a numbers game. The price has to go up because you always have a little bit of risk, okay? And if you know more about how to read chart patterns, please take a look at my book. It's on Amazon Kindle. I don't make money off it. I wrote it for people who want to learn how to read charts. It's 99 cents, and if you have the Kindle Unlimited, it's free. That's my community effort. Okay, you talked about adjustments when we're talking about the meta trade. Now, JSAFE is a very, very complex strategy. I know well over 1,000 different ways of forming it, and probably almost 24 management techniques. So I can't teach it all, but this is one very easy one that you could do, which is you're rolling the put up. When the stock goes up 10 or 20%, like on Meta, maybe it went up from 344. Especially my put is at 360. It's well above the 360. I can roll 360 to 370. Always make sure the price you're rolling from to is always below where the current price is. Otherwise, they get very expensive. But that's okay. From 344, we're predicting it'll go to about 460. There's a lot of room for growth there. So roll your calls, roll your put, at least get your risk out. And that way, you're trading with no risk. But always calculate your max risk, max profit, and risk to return ratio. Know that before you get into the trade to make sure it's worth it. Never pay more than 50% of the wing width, because then it's like 50-50. You're not gaining much benefit from it. All right? So, what do you do at the end of the trade? There are 3 ways to trade with it. Okay? Unless you decide to end the trade earlier. So, A, price went much beyond 460 that we had, which Meta did. So we would be assigned. Now, a lot of traders are concerned or even afraid of being assigned. That is one of the best things that can happen in JSAFE. Because what happens is you got assigned, they took away the 460 call, and they took away your stock. Okay? The only thing you got left is a long put. So you made your max profit, and you still have your long put, so you get rid of it, make a little extra money, so you make a little bit more than max profit. This is a gift the market can give you, but it doesn't happen often. And even when the price is well above the 460, you're not going to get exercised. Okay? It takes quite some time because of the time value. So the second thing is, you've got your put, you got your call. Somehow the trade expires when the price is in between. So if the price is higher than your cost, but you made a profit, that's great. You can still keep the stock or sell the stock. But if you keep the stock, you can do another JSAFE because you got some profit in there. Your cost is less than what the current stock price is in. Or the worst has happened. You bought stock where your cost was 100, the stock went down to 50 or 25. You know, people are pulling hair, and you're still smiling. Why? You have a protection at 100. So what you do is you exercise your put. Okay? How many people have exercised options? It's not commonly done. Okay. So on TOTS, right-click on the strike, exercise. In Schwab, they automatically do that for you at expiration. So this is similar to calling the insurance company and making a claim because you lost your house on the fire, as many people will do very shortly if they haven't already in LA, right? So you say, my house burned down, I've got it insured at that point, give me my money. They say, sure, we'll take your stock, which is at $50, and we'll pay you $100 for it. You got it. So you've incurred your max loss, and hopefully your max loss was nothing because of, you rolled up your put, and you get your money back. How great is that, right? So, this is something I added. As I said, I do a lot of research. Never satisfied with what I've got. I'm always trying to tinker and see if I could improve stuff. So I ran a Monte Carlo analysis, which was Tushar Mangrola's favorite. He was a very close friend of mine. We worked on a lot of strategies. So I said, what if I make 20% on winning trades and I lose 3% on the losing trades, okay? And maybe I have a little better chance of making money. Like instead of 50-50 coin toss, what if I have, I make money 60% of the time, lose money 40% of the time? What happens after 100 trades that are very randomly picked? Well, here's the interesting stuff. If I do that, 60 wins, 40 losses out of 100. The ending amount is $16 million after 100 trades, assuming you're rolling the money into the next trade. Okay. The worst scenario is I lose 2% to 98,000. So to me, that was really a mind-blowing thing. The potential for ruin is 0. You cannot deplete your account with this strategy. All right. One other thing, we started talking with risk, and just like you can see on the caricature, the risk tolerance is different for different people. Just you got to know what your risk tolerance is. Giraffes can go into deep water; it's not a big deal, but rabbits cannot. So you got to set up your trades in the way that works for you. When I'm coaching, that's one of the first things I try to understand. What is your risk tolerance? So that we can put trades together for your risk tolerance. It doesn't matter if the trade makes a lot of money. If you're taking huge risk and you can't sleep at nights, that's not the right strategy for you, in my opinion. I want to sleep comfortable. I want to sleep easy. That's why I gave up day trading. Okay? Even though positions were liquidated, it's just too stressful for me. But I love this. I don't care. I had a large position in AMD, for example. It was doing extremely well. It's doing really bad. Okay, even some of the trades where the current price is lower than what I entered, those trades are still making money for me, right? So I don't have to worry about it. The AMD goes down by 5%. The effect of it on my sizable AMD position is maybe a couple $100, right? So that's me, that's how I work. Lastly, JSAFE, in my opinion, is a much safer strategy than buying stocks. JSAFE 2, the one, 2 strikes in the money, is even better, it's even safer. So, but you gotta use the calculations here and to determine your risk, your reward, and risk to reward ratios. I have a spreadsheet for it. If anyone is interested, just send me an email and I'll send it to you. Just understand the behavior of the stock. Not every stock is gonna do well. For example, for SPY lovers, JSAFE doesn't do 5 to 1, okay, because the volatility isn't there. But if you're happier with a lower return, that's fine. On a big up year, JSAFE isn't going to return the SPY results, but it will protect you, will give you one of the best protected, insured risk-reward awards. I don't do it, but you can certainly do it. As I said, it's a very flexible strategy. I know of over 1,000 different ways of doing it, and I think I added some more ways. This 1,000 number is old, and there are various ways of managing it. This is the basic of the basics that I can teach you guys. And makes money, not guaranteed, but it's easy to put in. So there are many other ways of doing it, but not all of them are better than what the basic I showed you. I've had trades, results. I've lost the worst, probably, maybe it's not the worst, I don't know, maybe 36% loss in a really bad, risky strategy. And I just closed one for my daughter. She made over 22,000% on that trade, right? So they can go crazy varying. But this is the safest, or this is one of the safest ways of doing it. And it's easy. That's what I was able to boil down to. Any questions?
Yeah. I love your strategy. You can sleep at night, as you said. Right away, I look for holes in stuff, and that's probably a good thing. One is you got to be able to find stocks that are likely to go in a direction you can forecast reasonably, and I've got a technique for that. That's a no-brainer. But what I don't know that you could perhaps enlighten me on is is there an easy way to determine which stocks to focus on for the options? Because most stocks,
Volatile stocks.
very volatile stocks.
High implied volatility.
High implied volatility.
And where do I find out?
Go to Tasty Trade, they got a list of high IV stocks.
Or go to your Thinkorswim, if you have a Thinkorswim account,
Yeah.
then just go list the stocks, and you can have in your watch list, you can just have IV in a blank column, and then sort them by high IV.
Okay.
Yeah. We need to get going to the next presenter real quick.
All right, I'm here for as long as you want.
Yeah. So, Niki, did you want to say something or not?
It's like,
So, no. So Niki has been around for since the beginning that Brian put the whole thing together. And so we've learned a lot of the stuff back and forth together, and she has a particular style, and just going to give a quick verbal update of what that is. And up there would be good, because then we can get people to see you. old home week here with all these people. So, Tim, you want to drive up here too or not? Right after this? Oh boy, this could be interesting.
You want the back? You Indian, you here.
Is that good? Okay, we good? Oh my gosh, so good to see some of you guys. I haven't seen you. Hi, oh my gosh, you guys. Okay, enough of this. So I'm totally unprepared. I apologize. And I thought this was at 11 o'clock. It's at 10 o'clock, so I was late. Anyway, I've been doing the same strategy for years and years and years. I didn't hear the whole presentation that this gentleman just did, but when I did come in, I'm hearing a lot of what I do. So I'm just going to give you a real quick example. So in August of 2020, I got assigned on Tesla. I had a short vertical put, 95.90. So, and I had 8 contracts. So I got assigned, so I had to buy it at 95, less the premium from the spread. So my cost basis was 93.33. So here I am, and I normally don't, I'm not an investor, of course we're all traders. I don't usually hold on to stock when I get assigned. So here I am with these 800 shares. So what I start doing is selling calls against it to get rid of it. And normally that's my intent, is to get rid of it, to get called out. But for whatever reason, I just kept hanging on to Tesla. So I started, and I sell my calls. I do 65 to 75% probability of being out of the money. So here I sell the calls on Tesla, and I sell when the stock is high. I'll sell when the stock's going up, that's when I'm going to sell. And I'll kind of wait and watch, and I do weeklies. So now it's coming up, so I'll sell like, say 65% above that. Tesla went crazy when, so I kept doing this for like years. I was doing it, trying to get called out, and I would never get called out. And then Trump wins, Elon Musk does the Doja, whatever it is, Tesla goes through the roof. So now I'm way down here on my short call, and it's up here, so it's like, doggone it, why did I cover that? But, okay, years go by, well, years, yeah, 2020. So now Tesla's at, what's it at, 3 something or so, and I still have I'm covered on, okay, so I had 800, so I'm covered on 3 of them, because as it's going up, I'll start going, oh, I don't want to cover too much, and I'll roll. I'll keep rolling. Every week I'm rolling. If it's going up, I'm rolling. So now I'm really covered on 3 of them down at 320. Oh, perfect. Okay. So, yeah, I'm covered like at 360. Doggone it, look where Tesla is. It's like at 394, and it was up to, oh my God, it was almost at 500, and I'm going, doggone it. But I still had, see, I had 8 covered at 3, so I still had 5 that I'm making money on. My cost basis was $93, so I'm happy, you know, it's making money. Could have been making more if I was more on top of it. And okay, so I'm really lazy. I don't like do all the records. I used to that way back when, but now I don't. I'll look at my phone. I've got, now it's Schwab, but pops up on my phone. I look in the morning, where are my positions? Is anything crazy happening as the stock's going up, and I'm going, got it. So then I'm selling all this time also. So if my call is down here and Tesla's way up there, I'll start selling puts and say, come on down here, come and get me. And I'll just keep doing that. And then if it comes down, my call's making more money, I'll roll the puts. And that's what I do, roll, roll, roll. I usually will sell naked puts because, I guess you could do verticals, but I've got portfolio managing, so naked puts work out just fine. And so that's basically what I do. I just let me see what I wrote.
How long have you been doing this?
Oh my God, when did we? Okay, we started like in 2005, right? So, and the last meeting I went to was years ago. Oh my gosh, so I've been doing it for years.
Niki has online, if you go to accessprofits.com and look for Niki, you'll see Niki's presentations and when she started doing some of this. She was doing it on Priceline before.
Yeah.
And did you give it up Priceline?
Well, it's now Booking, and I do have Booking. So same thing with Booking. So I got assigned, same strategy. Okay, that's when Trump, the same thing, Booking and Tesla. So when Booking screamed way up high, and I got assigned 100 shares. I had one contract. So it's covered, my cost basis right now for my 100 shares is 40.60. And I think Booking it's way up. So it did a shoot up to the sky too. I was covered down low. So now my coverage, because of rolling, I'm covered at 43.50. But look where Booking, like when it went up in the 5,000, I'm going, God, I should have uncovered that. But it got so far away from me, and I thought, it can't keep going up, right? So I didn't buy it. I didn't uncover it. It's like, shoot. And every time I look at that, I go, God, and I should have uncovered it. But I'm fine because I'm still making, it's still profitable. And I'll just keep rolling. I roll when it comes down, and then I sell that's when it comes down, I'll roll that short call, and then when erase that. When it's up, okay, wait, let me look. Okay, so yeah, when it's down, I'll roll the short call. And I'll buy the put. I'll buy a put because it's coming down, and I want it to come down. So I'll sell the put down there. See, I'm so unprepared. I just do this automatically. It's hard to tell you what I do. But anyway, yeah, roll and sell. And basically, when it's coming down to my short call, which is what I want, because then I can roll it up and make a little bit more money. I'll sell that put way down there, and even though it's very far, because I'm not going to, I'll get nothing for a put at 43.50 where my call is. I'll get pennies. So I'll go up like maybe right now, maybe 45. I look at the percentage, so I'll do like 65 to 75% probability. And I just keep doing that, and that's what I've been doing forever. Sorry, I'm so unprepared, but I'm very busy. Yeah.
How far out in time do you
Oh, I go weekly, so I'll just go a week. Now, since with Booking, I'm covered so low, in order to get a premium, because I want to do it for a profit. I don't want to do it, I don't want to take a negative. Sometimes I'll have to go out the next week. But I do weeklies. I'm very, very short term.
But don't you ever get assigned by your shares taken away by the short calls? Or you just roll?
No, I'll roll it. So I'll normally roll, once in a while, I think I did get assigned on a different stock. I did get assigned. But they took it, it's fine, because I was still profitable. So it wasn't a negative, because every time, because when I get assigned, now I'm selling the call up. So if I do get assigned and they take that, I've made money on that. But I'll look on Thursday, and I'm familiar with my stocks that I'm doing it with. And so I'll look on Thursday and say, should I roll? How close am I? and I'll either roll on Thursday, and I'm really bad for this, don't do this. I wait till the last minute, I want every 5 cents. It's like, I don't take the profit when I have profit, I wait. I want it to expire, and don't do that because it's not a good habit to get into.
Bill Burmeister, does that sound like somebody familiar?
Here's a question on
Is that what you,
and that is, how far out are you going with your expiration?
1 week.
weekly, I just do
What
weekly.
is each roll monthly?
What is each roll?
Says, what is each roll monthly?
I-
I have to explain that question.
So, no, so it's just, she rolls it weekly. Everything is weekly.
Yeah, the only time I don't do weekly is if I can't get enough premium and I have to go out to the next week, but I don't do monthlies at all.
Okay. We go on to the next. Thank you very much,
Thank
Nikki. I appreciate it. I'm going to set up for Tim here. This is yours here, right, Jim? Erin?
Presentation online, Ken?
What? Yeah. Oh, not her. I mean, right there? Ah, got it, got it. Yeah,
Hello?
yeah.
Wow.
Cool. And stay away from the front of the speaker because it'll go whistle at us.
Yeah, it's,
So I'm gonna handle the slide for Tim.
listen to myself. I don't know if I like this. So, let's see. I waited till halftime last night to send Ken this because I didn't know if I wanted to cover up that I was at Ohio State, but turned out well. It was a good risk, I guess. So I have a Bachelor of Science in Welding Engineering. I worked in the automotive and aerospace industries at the beginning of my career and decided I could do better in software. So did software for 25 years. I guess I still do it. I did a lot of video type stuff, video compression, and when you used to have Blockbuster and you wanted to back up your DVDs, I wrote the software that did that. Which is, and then moved into like niche government agencies doing video surveillance. So let's see, I've not really worked for I think 16 years now. I've been I traded before then, mostly like buy and hold stuff, but I'd say more than 10 years ago, 2013 is when I really like dove into option trading. I dabble, like just as a hobby, I dabble in CNC and 3D printing and design. So, go ahead, Ken. So, I followed Ken's template, and I think I might have some cart before the horse here, but the one thing that we observed today, I feel like, is just how everything is so personalized. So you hear one person's strategy, you think, well, yeah, that works for them, and you find little, bits and pieces you'd like out of that. And like Brian's, buy, spy, and hold it. And the thing, I guess, about options, it just gives you so much more flexibility in my mind. You take Jack's strategy where he's playing options and he's got very little risk. And then you have Niki's strategy where you think, oh my gosh, she's got humongous risk, but she's so mechanical that she really doesn't. I mean, statistically, you could have some sort of black swan event, but she actually is so mechanical, she can handle those things. That she knows to roll and this happens, and it's the way she just even described it. It's second nature to her how she manages her positions now. So if you want to learn option strategies, I know probably a lot of people here are pretty sophisticated and know it, but for the person that is like, I don't even want to speak up and because whatever, I don't have a good question or whatever, I just feel like Tasty Trade is just such an incredible resource to just go learn everything, and it helps you determine your own personal, what you're comfortable with. So Ken had on his template asset allocation. So the way you want to, I feel like you want to allocate your assets And this is on a trading account because like you can have different buckets of money, and I'm strictly focused on like a heavy trading account. You want to look at your asset allocation in that trading account based on what's going on in volatility. So like I pay attention to what my buying power is, and this is what I try to do with when the VIX is at the different levels. So like I don't follow it like strictly, and it depends again on account size. If you're in a smaller account, you're probably going to be even higher than some of those numbers. But it really comes down to, I treat this as a guideline, not necessarily a rule. So go ahead, Ken, go to the next one. So as I said, very flexible, objectives. I already pretty much covered this. Account size, what your risk profile is kind of how you allocate your assets. And then in that account, you do like 75%, what is typically classified as undefined risk, and 25% defined risk strategies, iron condors, verticals, things like that. And then the 75% is like a Niki strategy. And you don't have to be trading Booking or Netflix or Meta or anything. You could go even smaller and just kind of just do the exact same mechanics she does. You sell your puts and calls, you go one side or the other, get assigned. Some of the smaller stuff that's hard to borrow, you may have to close out of. You close out of it, but you treat it like you didn't, and you just, keep rolling that way. You roll up or down. Go ahead, Ken.
The 75-25 rule, Nikki, do you use that same kind of allocated capital? Put 75% in your unlimited risk and 25% in
No, I
your...
don't even pay attention anymore.
Well, it's not, but don't misunderstand, Ken. I'm not saying 75% of your account. Go to the previous slide, 75%
of your trading.
of what you allocated
Right.
at the VIX level.
Right.
Yeah.
Okay. To me, those numbers, I'm going to still have
It
to
sounds
think
like
about that.
she's at 100% of an undefined risk.
Whoa. Okay.
Almost.
Yeah. Ooh. Well, yeah.
Yeah.
I mean, of her option buying power, we'll say it that way, because you're assigned, you're getting assigned and then doing covered stuff after that. So my primary focus is on like short strangles, short straddles, iron condors, butterflies, symmetrical, asymmetrical. Like if I get an opinion on where I think something's going, I mean, how often am I right? Am I right 52% of the time, like the market? I don't know. But, and then a lot of, like if I get assigned something, I'll do the wheel strategy and try to get called out on it. And then just basically start over, and you're selling the put. So if it comes down and you're inverted, you just keep rolling as long as you can. And then if you get tired of it, you just, you re-invert it, you pay out a little bit to cover it. But if you look at what you've collected, like over months even, you're in pretty good shape in most cases. So lots of rolling out in time, lots of rolling up and down based on what's going on. I tend to go out a little further. I tend to do things, like if something's down to 20 days, I'll roll it out to 45. And that's literally Tasty Trades, like bread and butter. That's what they do. And somebody was asking before where you find the trades. I think you were. I think everybody that pays attention to that network trades all the same stuff, and it's everything that everybody's already mentioned here. And it's usually the highly liquid things, higher volatility index, high open interest, gives you all better opportunity. And go back one more. I do try to close my winning trades at like 20 to 50% and then reestablish. And I decide, is this still worth going into or not? Certain things I tend to have on a lot. So go ahead, next one. Let's see here. So again, a commercial for Tasty Trade. It's just, if you just want to learn that it's free, you don't have to pay anybody. You got professional traders on there. There's enough different personalities. You'll find somebody you like, and you can start. They put their trades on. You start tracking them. You see how to do. It's just like, it's just a really good place to go and learn about something as simple as just doing a covered call or buying. Like, say I want to buy a stock, instead of buying a stock and you could afford 100 shares of a stock, why not just start selling puts until you get assigned? And so you're almost buying stock at a discount. So if you would have bought the stock and it went down against you, you would have lost that. And even if it goes below what your premium was you collected for the put, you're still better off than if you would have bought it at wherever you decided you were going to go in to begin with. So they've got a comprehensive focus on derivative trading, options, futures, and the power to, like, literally in options, you could define any amount of risk you want to take. Jack strategy, minimal risk. And you're still getting, what the amount of risk you're going to take is typically in proportion to what the amount of reward you're going to get. The other thing about Tasty Trade, you got a CEO of a company that literally, and we're kind of blessed on the West Coast here, you can send him an email like towards the end of the day at night, and I'm convinced he does last in, first out, because usually by the time I get up ready for market open, he's answered the email. So you're literally writing Tom Sosnoff questions and he responds, and I'd say many times my question will end up like, oh, somebody asked me last night, and he'll answer on the air. So it's it's kind of interesting. There's not many CEOs of billion-dollar companies that are available to just send emails to and get a response. The downside of it is there's so much content, there's a lot of noise, and it's hard to find the signal. So it's like you hear something, because I tend to keep it on like just on my TV, and then hear something I like and you want to go back and try to find it. It's not always easy to do that. Go ahead and go forward. So just a couple things of my favorite things on there, where it gives you like where to go immediately to get start getting comfortable with everything, is they've got a whole learning section, all free on their website. The market measures is almost like every day, I feel like, and that's on YouTube even too, and you can figure out how much to skip, because they always have like intros. So I feel like that's almost like every time there's a market measures, I feel like that's worth watching, because it's theory and it's all based on their research team. They literally have a research team that runs back tests on all their strategies and will give you the probabilities of everything. I like the style of Liz and Jenny. They're two ex-floor traders that have been doing this for years, and just kind of fun to listen to, good personalities, good trade ideas. Confirm and Send is another one where people send in questions, and that's the one that they answer. And that's the one, like if you ask a good question overnight, typically you'll end up on there, and they'll use your question on the air. So go ahead again. So, this year I had some health issues, a little touch of lymphoma. So the whole first half of the year, I was trading, but some days I woke up and just didn't feel like doing much, and chemo and radiation aren't a lot of fun. So I was kind of slow in the first half of the year, picked it up in the second half, and I had a pretty good year. I'm not upset about my year at all. And then just again, in closing, if you're interested in learning options at whatever level you are, there's something on there, I'm convinced, that can help you, and it gives you just a lot more opportunity to see how other people are trading.
Thanks. Any questions?
Great.
Okay, great. Scott, let me get you fitted for the
Question.
Yeah.
What kind of return do you?
Well, that's what I was talking about before. It's so personalized. Like if I said, like, oh, on one account I got over 100%, and then you got to defend that, I feel like with options and what your goals are, that's totally achievable.
Like Jack talked about, an annual basis or things.
Yeah, like you could take tens. That's why I was really just wondering about how to answer that, because I've got several accounts, and if you take I got 0.5%, and is that really representative? Yeah, again, it's so personalized. What are your goals? What account are you focusing on? It's certainly, if you're an active options trader on a small account, like 25,000 or something, 100% is achievable. So, yeah.
Thank you, Tim. All right, next up, we got Scott. Oh, you got it there, Scott. You want to give a brief background on who you are, Scott?
Sure. Oh,
Look, the microphone is hitting your wire there.
okay. My name's Scott Hodson, and I'm a trader. I've been investing for about 30 years, and actively trading 2008, so 16 years in terms of swing trading, day trading, automated trading. I think I have some intro stuff in here. So Ken just said, hey, can you give a presentation? So I just, instead of talking about me too much, I just figured I'd share a strategy I do. And I call it the lunch money trading strategy. Oh yeah, where you do at 5. Great, thank you. And there's my email address at the bottom. You can always email me and ask questions later if you want. Okay, yeah, before we get into that, so I want to give a shout out to Michael. Say hi to Michael, he's raising his hand. I met him and his friend Mitchell last week. Mitchell was busy trying to get some girls' numbers, so but I chatted with Michael. He's studying for the bar, so wish him well. He already knows he's going to be miserable being a lawyer, so he wants to get into trading, and he definitely brought the average age of the group down. So appreciate you guys coming, and so yeah, say hi to him and Mitchell, and they're pretty they're into zero DT trades and stuff. So I'm glad they're here today. So as an introduction, this strategy is called EARN, E-R-N, and it was a strategy mentioned on earlyretirementnow.com, and it's just a site about retiring early and extending your retirement funds and things like that. And they have a concept in this community. They have a concept called return stacking, which is basically if you have a margin account, put 100% in your portfolio in SPY, and then use the rest of your margin for other stuff. And then hopefully those make money, a little bit of money, you beat the market. You've already, 85% of fund managers don't beat the market. So they have this concept of return stacking. So one of the strategies he does is this EARN strategy, which is profitable and helps him beat the market. I learned about this from a guy named David Sun, and there's Tasty Trade has a Facebook group, and just different Tasty Trade traders that hang out on Facebook. David spun out, created his own website and podcast called The Trade Busters. He has a free Discord as well, but you have to pass a test to get access to it. So, and the answers are all in his podcast. So if you listen to his episodes of his podcast, there'll be the answers. And if you get the answers wrong, he'll even email you back and he'll say, look at episode 8 or look at episode 4 or whatever. So it's kind of a cool community. People know what they're doing. They're pretty smart. They do a lot of research. They have calendar strategies, premium selling strategies, all kinds of different option-based strategies. EARN is a short-term premium selling strategy. And by the way, I'm glad I was referred to as, I thought it was funny I was referred to him as the extreme premium seller. So maybe we'll see. I love the lizards. I remember the lizards. You can talk about lizards forever. And I think JSAFE and lizards need to spawn and create, J lizard, lizard safe. I don't know. I think that'd be a good combination. So, all right. So here's the strategy from David, as taught by David. And here's where the extremity probably comes in. It's a 1 DTE trade. And he and I and many others use this just on SPX. So we're just selling SPX options. We do it the day before the close. So let's say this Friday, I do it every day. I do it at lunch. That's why I call it lunch money trade. So around 12:45, I have an alarm in my phone set for 12:43 to remind me to do the EARN trade. Because sometimes I forget or I get busy or I get distracted. I literally have an alarm that goes off. Or I'm on a golf course, whatever. my alarm goes off. Oh, I stop what I'm doing, pull out my phone, do my earn trade. You sell a 15 delta put on SPX for the next day. So Friday I sold for Monday. Monday I'll sell for Tuesday, et cetera, et cetera. 15 delta put, 5 delta calls. And for every put you sell 3 calls. So it's a 3-to-1 contract ratio. Some people do this on SPY also. Some people do it on ES. They work just as well. The problem with those is you have assignment risk. So if you don't get out the next day in time, you can get assigned if they go in the money. Other than that, they're pretty good. The exits, now these is where it gets extreme. Your stop loss on your put is 7x. So if you got $3 for your put, you're gonna put a stop loss at $21. If you sold your calls for $1, that's 11x. So if you sell them for $1, you're gonna get out at $11, okay? And you let them expire. That's the exit. You either stop out or you expire. Now, some of you, your heart sunk to the ground. This is not 3.2% JSAFE, losses. These are big, these can be big losses. Now, in defense, one side is losing, the other side is winning, right? So it's not truly, like, the calls that are most painful because it's 11x and you have 3 times as many of them. And I'd mitigate that a little bit, I'll talk about that. But here's an example. So let's say you sell, I did this presentation first a couple years ago, so the SPX was around 4,200, or 4,300. So you could sell 3, I may sell 3 4,200 strike puts for tomorrow for $3.05. And then therefore I would sell the 5 delta calls, which they're 4,400 strike for $1.10. And then my stop would be on the puts $21.35, and on the calls it'd be $12.10. You put that order resting in your broker. You do not want to watch it, do a mental stop. You will be a deer in a headlight, and you will take a 20, 30x stop if you don't. I've done it, so I guess that's why I'm extreme. Don't do what I did. Okay. Here's how I modified this strategy, more to my insanity, more to my level of comfort. First of all, I don't sell naked. I buy low cost wings. So I may go 100, 200 points out and buy, I may buy a put. On the puts, I may buy 200 points down for 10 cents. Just to have some black swan risk, like if there's a nuclear war or something happens. I'm gonna lose a lot of money, but I'm not gonna go broke, okay? I also don't sell the 5 delta on the calls, I sell the 10 delta. And that gets me a little more premium. Some people in the community, when the IV is really low, these calls are like 80 cents, and they're just, the premium's just not there. I don't like to sell anything less than $1. If I'm gonna be buying wings for a dime or a nickel, I want to at least collect $1, okay? So, and the 10 delta gives me that. I almost always I can get more than $1 for 10 delta. Stop loss orders. So on the overnight, I'll place the stop loss order on the whole spread, not just the short. Because in the morning, that long, that's part of the spread, is gonna have some value. Later in the day, however, that thing 200 points out, it's not gonna be tradable. So at that point, I have to convert my stops to, if I think it might be hit, or has a chance of getting hit, I'll just put the stop, cancel the order, the stop order, and put it on the short put, the short call, not the long. Because the long's not tradable, it's too far out. And if you have the stop on the whole spread, it will never execute, because no one wants to buy or sell you something that far out. I also have this concept of boost. Basically, if I have a stop loss, the next day I double my size. Okay? These almost never, I say almost, have 2 losers in a row. These have an 88% win rate. So there's sequence, the sequence risk is very low. There is sequence risk, but they're very low. There was a double stop in December, and I didn't boost that day. I was just holidays. I just didn't want to do the math, I guess. I just did a regular trade. So I didn't boost on that day, but boosting has actually been very profitable. I've never had a boosted trade lose on me. But that's extreme, right? You're martingaling, you're doubling. Now, if I lose again, it's over. No more boosting and boosting. No more. You know, we're not exponentially growing these trade sizes. It's a one-time thing. Okay, one-time thing only. I don't want to break my account. Here's some other modifications I've done. So I don't do the 3-to-1 contract ratio. I do what's called credit targeting. So on each side, I want to get a certain number of dollars. So for example, this helps me adapt to the current market volatility regime. So for example, in the Davidson or traditional way, I would sell X puts at 50 delta and 3X calls at 5 delta. In this case, the number of contracts are constant, but my income varies day to day. The way I do it is to say I want to make $2,400 a day, so I'll sell $1,200 worth of puts and $1,200 worth of calls. The number of contracts I'm trading is different every day. I mean, right now I'm not trading very many contracts because the volatility is somewhat elevated, so I'm getting good premiums. So I don't have to sell a lot of contracts to get $2,400 a day. The income I receive is constant. And however, on low IV days, I have to sell more contracts than on high IV days. And those stops can be painful because I have a lot of contracts and I collect a very low premium. So on low IV days, I'm a little careful. I'll buy some VIX call butterflies or something to help hedge the fact that in low IV environments, you don't collect a lot of premium and the volatility can shoot up really fast. So here's a back test of kind of the traditional Davidson version of the strategy. It's hard to test it the way I do it because I have this kind of variable contract calculation I do. But this is a $50,000 account has a 24% CAGR. And this is three calls, 1 put. You could literally do it with $30,000. This would be even higher CAGR because 3 contracts, $100 wide, that's $30,000 of max risk. And if it's portfolio account, you can even do less. You can, because you have span margin, you don't need to cover, you don't have cash for the full max loss, right? But again, that's risky. But so I just said 50,000 for this, and CAGR is pretty nice. So there is an edge, right? This is from 2021 to yesterday. This is why I got my slides so late and I had to rerun this. The last version I had of this was when this just went up to 2023. My results, I started trading this in 2023, around June. So I do have a margin, I do have a portfolio margin account. I use SPX. Like I said earlier, it's cash settled, no assignment risk. I get 60/40 tax treatment, section 1256, tax treatment. For 7 months, I made $20,000. And then for 2024, the strategy I made $24,000. The last half of the year was bad. 4 of the 6 months were losers. December was rough. And what I found this year is it was like July, August, September, and December were all losers. And basically you lose money when, with any premium selling, right? When realized volatility is greater than the expected volatility that you sold your premium for, that's when you lose money, right? So the volatility surprised you and surprised the market. And what I found is these periods of low liquidity or like July, August, September, people on vacation. December was bad. It was the last half of December was bad. People were on vacation. So these periods where institutions aren't trading as much, you get a lot more expansion of volatility that's unexpected because it's easier to push the market around by small firms or by big firms that aren't going to have a lot of people, fighting them from moving the market around. And so I think going forward, I want to be a little more careful around these periods of low liquidity or low institutional involvement. Anyway, so that's the return. So what's the return on capital? Because that was one of the things Ken's template had. It's hard to say because I have so many strategies involved in my account. And when I put on a trade, like if I say I want to sell some calls, and I look at my margin required, it'll say almost zero because I have so many short puts already. It's like, yeah, you go ahead and sell calls because you already have so many short puts. You're not adding any more margin to your account. So it's hard to say what is my return on capital, but I would comfortably do this at the least, $80,000 to $100,000 to reach those $20,000 return levels. So about 20%, maybe 30, 80,000. There's some variance. Ooh, running out of time. There's variance on this strategy. I'm out of time, so should I keep going or no? I got like 2 more slides.
You're pushing the envelope.
Yeah.
It's 15 minutes here. I want to give some time for Jim here too.
There's variance in the community with the 7 DTE hedges, less theta decay. The front side, your short dated contracts have higher gamma, so longer DTE. They have less theta decay and they have less gamma exposure as well. So it's one way to hedge. There's different variants that use 7 DTE strangles to hedge it. Automation someday, but I like to shop the chain myself manually. Build versus buy. There's automation platforms that'll automate this for you if you want. They're all listed there. And there's some active hedging I've been experimenting with. And I don't have time to go through this trade, but this was a nice hedge trade that saved me, about $3,000 last week. And I'm gonna keep doing this. It works for me. I have a job, so I do it at lunch. Like I said, 12:43, my alarm goes off and I start doing it. It takes me 5 minutes to do. So that's it. Any questions?
Thank you, Scott. You want to take one question from the audience? No?
Well, you mentioned section 1243, 60/40 on IRS code. I understand some of that stuff for futures. That also applies to options?
For SPX, yeah.
Oh, only for SPX or for other things also?
SPX, I think RUT also, VIX. Pretty much all index stuff, yeah. I would not SPY, not ETF stuff, but yeah, indexes.
Anything that doesn't have a stock.
Right. And it's not SEC regulated pretty much.
Thanks, Scott. Now, next, Jim. We barely made enough time here for you, Jim.
So, looks like
Don, I think we're doing pretty good. We're almost making it to time. You were saying it would be hard to make it in 15 minutes apiece. So we're doing okay. We need to go through the questions, but yeah, great. Go ahead, Jim.
Good to roll? Okay. Hi, everybody. Nice being here today. I'm seeing a lot of people I haven't seen in a while. That's really nice. Well, my name is Jim Rakowski, and a little bit about me. I was born and raised in northeastern Pennsylvania. Went to college, got a doctorate degree in mechanical engineering. After I came out on the West Coast and started working, it wasn't long before I started to get interested in real estate. So I did that for quite a long time. There was a lot of times when it didn't seem so much as an investment as it was as a night job. But then actually that was a really good thing. And then I got interested in the stock market, and I didn't really know what I was doing. You get online and they'll tell you this and they'll tell you that. It takes you time to really find out what's going on. Probably the best thing to do is join a group like this, and then you get to the bottom line a lot faster. Back in 1998, I got a postcard in the mail from a company called VectorVest. And it sounded good, just on that postcard. And it also said that they were having a seminar in Phoenix, within a week or two. And I drove over there and I attended their 2-day seminar. I thought it was really fascinating. This is not going to be a tutorial in VectorVest, but I want to mention it as, like Ken was saying, well, we want to know the references, what's behind the material we're presenting, and I can tell you that I have an extremely high opinion of that company, because when I started at the turn of the century, like around year 2000, they were very limited in what they did. Of course, I didn't realize that because the first time I was looking at it, but now they've got everything and they're very good at it. Long-term trading, prudent investor trading, really good stuff on short-term trading, options. They even have a full retirement investing course. It's a little more expensive, but they even have a coaching room. So, you can learn all about it, and you can go into the coaching room and you can see them execute that in real time. Something that I may do, actually. So anyway, I was really technical. I'm kind of a technical person, obviously, because I'm an engineer and I like technical trading. At the time, VectorVest wasn't really into technical trading hardly at all. As a matter of fact, Bart DeLuto, the founder of the company, who is an engineer, graduated from MIT, has developed the phenomenal basis of that company, but he was still more of a fundamentalist, and he used to sometimes laugh when people would point out head and shoulder tops on the curve and things like that. He'd say, you're seeing things. But all that changed with that company now. Now they're at the forefront of everything. So I just wanted to give you that background that for anything that I present today, you can go to VectorVest, and in fact, that's where I'm getting my information from, and it's pretty awesome, I can tell you. So anyway, I'm basically a TradeStation trader. I program trading strategies. The way I look at it is I do the research and development, and then I will turn the strategy over to the computer for execution. So I can stay out of that loop, because fear and greed really interferes a lot with what you're doing. But just like Brian mentioned and Jack mentioned, the first thing you need to do is control your risk. And if you control your risk, then the profits will come. And the way I can control my risk through program trading is I can put in any kind of exit strategy I want. Stops, profit targets, whatever the case is. And that's the way that I would control my risk, is by programming that risk control right into the strategy. I know what it is and I know how it's going to work. Now, one of my biggest problems in trading and in life in general is lack of consistency. It shows up in my trading. I'll have these humongously big years and then I'll take losses. I'm also an avid horseback riding. It shows up in my riding. I can ride really well one day, and one day it looks like real crap, And I see that and I laugh, because I know there's like nothing I can do about it. So anyway, let me go forward. So what I wanted to do was, where I'm at right now is this. I came to the conclusions. Ken and I had a conversation recently, and I think we're right on the same page, that I decided to turn a lot of my money over to what I guess Michelle was referring to as fixed investments. I thought, I want to be able to invest in things like even like CDs or high interest rate bank accounts. Like early last year, there was we were getting 5%. You said I gotta have enough money that if I can make it at 5% into something with no risk of principal, I'll be happy with that. And I don't want to have all these positions and whatever it is on my screen on TradeStation, because it's too cluttered. So I send them the largest amount of my money over to US Bank and talk to one of their investment advisors. They have this sort of Wealthscape investor in US Bank. And we talked about putting money into an annuity that was giving me 5%. Treasuries at the time was giving me 5%. I was happy with that. No risk of principal. But then I wanted to allocate a certain amount of money to dividend-paying stocks, something that I hadn't got into, but I was starting to get interested in. And all of this is really happening this year. And so I did that, and I'm happy with what I'm doing, and I'm going to show you that today. And in addition, I stumbled on something that I consider to be very interesting and something I've been able to take advantage of that I wanted to pass on to the group here today. One thing about VectorVest, just to get to the bottom line, is that they are not a buy and hold company, even for prudent investors. They'll tell you when to buy, what to buy, and when to sell, no matter what. They have great growth and income courses, for example, and they'll tell you, there's no point in holding on to a stock that's going down and lose 30% for getting a 3.5% dividend. So they know all about that stuff. Okay, so let's move on. And Okay, I guess I can use the mouse here. Can we just down arrow here, Ken? Is that it?
Press the space bar.
Okay. People ask me about presentations, and I say, you know, I don't like to present tables. I like to present graphs. They're a lot easier to make sense of, but today you're not going to see that. This is the VectorVest home screen. I just want to point out, you know, that they have a lot of free seminars and a lot of free courses and a lot of free education, just like was mentioned in TOTS. Their subscriptions are not that expensive. You can get, you know, like 15-minute delay data type of subscription, or you can get real-time data subscription, which is what I got. For that, I pay about $1,200 a year. I think it's higher than that in the beginning, but somewhere along the line, they're going to give you a discount. One of their main market timing systems is that color guard dial up at the top. And I have to tell you, I despise that thing. I'm smart enough to know red and green, but I'm not smart enough to know red, yellow, and green. Okay. But it turned out that in the middle of year 2023, they gave another one of their free seminars, and there was a gentleman at the time who was head of VectorVest UK, gave a presentation, and I looked at that and I said, son of a gun, I said, I can program that, but it's not that thing up there. It's something they call their DEW, which stands for Detrended Price Oscillator, Envelope, and a Weighted Moving Average, and they put that together to give buy and sell signals on the overall market. So their main thing, which I can tell you is really important, and they're right, is that, you know, they say you do not buy stocks unless the market's going up. And then, well, how do I know when the market's going up? Well, their market timing systems, one of them which they have, will tell you when the market's going up if you want to believe it. But there's lots of ways you can get buy and sell signals on the overall market. And I'm just telling you this because that concept alone, when I was able to work it into my strategy trading, has helped me enormously. And it's helped me to become far more consistent than I've ever been before. So let's get on with this thing. Okay. Inside of VectorVest, you're going to find a viewer screen, and it's full of watch lists. They've got watch lists for everything. You know, they rank every stock in the that exists, and they can give you a list of their hot stocks. They can give you a list of their dividend-paying stocks. They can give you a list of their high-growth stocks, and this is a list of. They have actually under dividend. They have dividend stocks. And in the subgroups of the way they scan, they have monthly dividend payers. And that's what I like. So I went into monthly dividend payers, and I started taking the stocks and ETFs out of that list because it's nice to get paid monthly. And there were some pretty high dividend paying vehicles in here. And what I discovered was there were some really high dividend paying vehicles in here. And here's what they do. There's a company, for short, it's called WiMAX, and I know the screen is a little hard to see. But what they do is they buy or they invest or they do whatever in certain things, and there's a number of them that are pegged to Bitcoin. But I don't want to just talk about Bitcoin. They have other ones as well, and what they do is that they hold these things and they write options on them to make income. And we've heard a lot about options today. So you'll see over here, it's the viewer screen, monthly dividend payers. Note the number of high dividend option ETFs. So what we have over here, for example, is the one that I'm in, and I'll speak a little bit more on that because I have a history with it, is Conny, C-O-N-Y. It tracks the Bitcoin Coinbase. MNRY, MRNY. I'm not too sure what that does. Alta Y might be tracking Alta Beauty. AMDY is tracking AMD. AIYY, I just saw that one last night. It might be artificial intelligence, a group of stocks. Like, for example, I'm in one right now, an ETF called Chat. And it has 18% of Alphabet, Microsoft, and NVIDIA.
Hold on a second, Jim. Is this too loud for people? Yeah, can you turn it down a little bit? Let me turn it down.
Yes, do that, because I was having the same problem before.
Yeah. Stand in front.
Okay. Oh, I know that's different.
Better?
Okay, very good. Okay, thank you, Ken. I'm good. Okay, so anyway, these are the things that I happen to find over here, you know, that were really high. Now let's take a look. Now when you take a look at the screen here, it's full of VectorVest proprietary entities. But over here on the right, EY is for earnings yield and DY is for dividend yield. So from Coney, they're saying that the average dividend yield in the past year is 161%. And if you look at MRNY, 137, 117, 114, and you get down into the 70s and 50s and 40s on these vehicles that they're writing options on in order to earn income, and they're passing that income off as dividends. So, I didn't know about all of these, but I saw Coney, and actually there was one called WiMAX as well, but I'm out of WiMAX. So I did invest in Coney, and it went really well. We have Bitcoins and some of these vehicles.
Quick interrupt. To let people know, this is using the wheel strategy, and they're so good at it that they basically created an ETF using the wheel. And to create 150% return per year on dividends, wow. So it simplifies your work, just basically buy the equity, like what Jim was talking about, and he did it.
Yeah, then let them do the options on it, you know, right, that kind of thing. Okay, so let me go on. So my income stocks and ETFs, the ones that I have, are the ones that's followed. You have Coney, which I mentioned, and MNR is a new one, but that one's paying like 18.6%. Now, I don't know if it's paying 18.6%. I'm saying that the average over the past year was 18.6%. You have to go to a website and find out what that dividend is right now, because these things are not going to remain constant, so I found out. And I don't know how constant they will be when you go from one to the other one. But then I have like BlackRock Capital. That's probably a large cap fund. You notice that this one is sorted by industry. VectorVest will tell you that no matter what stocks you buy, you should diversify your holdings by industry as well as other things. Okay, so what do I have? I've got 3 petroleums. Well, no, this one isn't sorted by industry, just a minute. Yeah, sorted by industry. Okay, so I have this Coney, which is some kind of a specialty thing that's pegged to Bitcoin with option income. I've got 2 financials, which is Bain Capital and Pennant Park. The ones that are in the market are that's a large cap, and the other ones are probably some kind of bond funds, including the one that Ken gave me, which I really like, which is PHK, which is PIMCO High Yield. And a couple of the others in that category are kind of the same. Altria, you know, we know that, that's tobacco, MO. I've got 3 petroleums, ETMplex and MMR is one. And then I've got 2 REITs, AGNC and DX. I don't have DX in there yet, but I'm going to get rid of one and put DX in pretty soon. So that's what I've got. So you can see that what my yields are. Forgetting about Coney, you know, there's a lot of them that are well over 10%, some are not. I think my average yield I calculated is about 12.2% across everything, because all my position sizes and all of these are about the same. So now what I want to do is say, hey, you know, I want this kind of a thing to pay my expenses. And so I have a spreadsheet at home where I look at what all the kind of money that I have allocated, what my dividends are going to be, what my major expenses are going to be, which is going to be, you know, home insurance, car insurance, exorbitant property taxes, and double exorbitant horse fees. Okay, so anyway, so when I see all that's covered, fine, I could settle down, and then I can do everything that I'm doing already. I'm just doing it with a lot less money as far as my strategy trading is concerned, and I'm really comfortable with that. So that's what I'm doing. Some of the growth stocks I've held, and I'm going to tell you, if you have VectorVest, I can be a lot more confident about stocks that I buy. But I'll tell you that when I show you a chart later. But right now, I've got like MCore. There's a Bitcoin that doesn't pay any dividend. Chat is the one that contains the AI stocks. ELF is L to beauty, which is always recommended, and you know, it's got a pullback. I can't remember why EXT is. It was highly recommended when I ran it through VectorVest. Their statistics were good on it, therefore I bought it, and it's more of a low price stock, 653. IGM is a narrow space sector kind of ETF. And Grab, it's a financial, and I can't remember, but it looked to be rated pretty well, plus the fact that it was a very low price stock, and I figure I don't have a big position in it, I'm going to buy that one. I don't have stops in any of that, by the way. Okay, so this is the basic curve that you're going to get, or the basic chart. If you type a symbol into VectorVest into a watch list and then chart it, you're going to get something that looks like this. Now you can make these charts look differently, but I want to bring up this one. It's really important because for VectorVest, they will look at the price pattern and the earnings pattern. And the nice thing about VectorVest is they take all these things like growth rates and earnings and everything else, and they have proprietary ways of consolidating them down into one number. So like, for example, they have, if I showed you the chart there, the table that I have, they have something called the GPE. Well, the GPE is just the inverse of the PEG ratio. So instead of looking for small numbers of PEG ratio, if you use the GPE, you're looking for high numbers if you do sorts and things like that. What they want, okay, is a price chart that goes from lower left to upper right, and they want the earnings, EPS in the blue envelope, going from lower left to upper right. That's the premier, highly rated stock that will be defined in VectorVest, is the chart this way. Now, those are for my growth stocks. As a matter of fact, this is EME. This was the first one I had. And you can see that. And the other thing that's nice about this is that I'm sure that we all get on the web, you know, we're on the internet, if we do anything financial, pretty soon all the articles start showing up about income stocks and growth stocks and this and that. Well, if you read these articles, you know, they'll give you, what they'll do is they'll give you the story. The one thing this doesn't do is it doesn't give you the story. I mean, I don't know why EMA is so good, you know, but if I read something that's recommended, they'll tell me why, but they won't give me this information. So you know, they say now, be careful, don't take these tips, these stock tips. Well, if you have VectorVest, you can throw all these tips into a watch list and plot them. And when you get charts like this, hey, I've got the price pattern and the earnings, and the article gave me the story. Okay, that's the way I look at it. And if it comes to an income-producing stock, you're often not going to see that lower left to upper right, because what it's doing is it's taking those earnings and it's distributing them to the shareholders. So I want to see something that's pretty stable and just tracking horizontally around the screen, but I want to see that earnings picture anyway. And that's the way that I look at it, and that's the way I select my growth stocks and my income stocks. Let's go further here. Like, for example, here, this is Bain Capital Management. It goes back 5 years. Well, back in 2020, everything crashed, but pretty much, you know, it's kind of like horizontal. And it's got a dividend yield that's about 9.9% right now. So if it wants to shovel those out, you know, on income and, you know, as dividends, that's okay with me. I don't need to see big growth here on an income stock. But I want to see this. See? I see good earnings all the way. Yeah, it's fallen off a little bit over here, but I'm not worried about that. But I want to see this, and I don't care if it's a skyrocket up there. Now, where I go for my dividend information is I go to marketchameleon.com. It's free, and all I have to do is type a symbol in the upper right-hand corner. It will give me the dividend history, and it will give you the projected dividend and the announcements for the projected dividends coming up in the future. And that's what this does. And this is a monthly payer, and down in the lower pane, for all those that have been paid, you can see it's going month by month. But the thing that happened this month was that they cut the dividend from, when I started investing like 4 or 5 months ago, it was about $1.04 per share. The stock price might have been about 14 bucks. If you pencil that through, you might get something close to about 96 to 100% dividend yield. And all of a sudden they cut it. They projected to be zero, but when they paid it, which is yesterday, they recorded on Wednesday, I did get like 83 cents a share. But from now on, they're projecting 0. Now, maybe they'll change that next month. But right now, I'm thinking about dumping this thing. So where do I stand? Because the Bitcoins have come down, and this one has come down a lot. Let me see if I have the chart here. Yeah, see, this is Coney right here. And you can see on the right, you know, I've taken this loss. So what happened? Well, it turns out that I made a $1.04 a share, then I made a $1.10 a share, and then they said it was going to be 37 cents a share, but when it came out, it was $2.02 a share, and then another $1.10 a share, and now it's 83 cents a share. So if I take all the dividends over if I was in, I can't remember, it's 4 or 5 months, if I'm in it for 4%, if I add up all the money I made in dividends and subtract the loss that I've taken recently, I'm still up 15% in 5 months, or 4 months. And if I was in there for the previous month, I'm 20% for 5 months. So I'm still good because of this horrendous dividend that they're doing by doing the wheel strategy that Ken mentioned. Let me just go up here a little bit. Okay, so you can see in the middle pane, they're all zeros, and I'm kind of nervous about that. On the one hand, on the other hand, since the price has fallen so low and it's on support, I might not dump it, but I might say, okay, well, we think that we're bullish on the market now because of Trump and the statements they're making about Bitcoin. Maybe I'll just hold it to see if I can make some of that loss back, knowing that I'm not going to get a dividend in the future. But maybe they'll change that. You know, maybe they'll start making money on their options. But there's alternatives, and that's what I wanted to talk to you about. So if we go down here, from that list of monthly dividend payers, I just extracted like the top 8. And I ran them through Market Chameleon to get the recent dividend payout amount. This is in dollars per share. And they have the current price is in the second column. And if we go over here, that if I take that price, and if I take the dividend payout and divide it by the price and multiply it by 1,200, it's 100 to get the percent and 12 because they're paying once a month for the year. Then I'm going to get the yearly yields that you see in the fourth column. You know, the bottom one is 48% and the top one is 130%. Now it could be that I'll sell that Coney and I might distribute the money between AIYY and MSTY. MSTY tracks the stock MSTR, which I think is isn't that an AI stock or a semiconductor? I can't remember.
They hold 400,000 Bitcoin.
Okay. So, you know, I might do that. But the question is, why would I do that? Well, this is Coney, it's down. MNRY, but this is also down. Okay, so maybe I'll just jump over here because now they've both taken losses, really. They're both consolidating. But MRNY is paying a dividend, but Coney is not. And the other thing I noticed, and I'm glad I just remembered this guy, but you notice the high volume on the right on that consolidation? To me, that's accumulation. I don't know if anybody ever read a book by, I think it's Richard Arms, and he talked about stocks that go square. I'll never forget that, that's why I know him. But anyway, if you're on the bottom on support and you see high volume and that stock isn't moving, that means because it's being accumulated. In other words, the buyers, the sellers can't push the price down anymore because it's being bought up. And if you're up at resistance and you get a high volume and you get flat, that means that the buyers can't push it up more because everybody's selling into it. So I think this is a very good pattern. So I might move maybe half the money into MRNY and maybe half the money into AIYY, which is a similar condition with high volume on the right-hand side. And I'll just go with that because they're really high dividend pairs right now. They're over 100%. And it's only because they're writing options on it. So if I keep going, this is MISTI. This is CRSH. I like this. Volume is okay, but I don't see that cluster at the end. That makes me feel more confident. This one is YBit. It's tracking some Bitcoin. And what else do we have? We have NVIDIA. So there's NVDY. So this is a vehicle they have that's tracking NVIDIA. and they're writing options on that, and we have a similar pattern. All this stuff has really taken a beating recently. And that's basically it. I'm gonna diversify across. I'm gonna keep all these dividend vehicles that I have, but I'll probably get rid of county, and I'll probably buy 2 of the high ones that I've seen now that still have positive dividend announcements coming up in the future. And I'm not gonna bet the ranch on these stocks, but they'll probably be just an equal position of every other thing that I have, averaging out to now. Maybe that'll drive if I get a couple of these, it'll drive my average dividend yield up to maybe 17-18% a year. And without taking too much risk, because I'm spread out over a number of positions that I have. And that's all I have to present today. If there's any questions, Michelle?
You may answer this, but you don't reinvest any of the dividends, do you? You take all the dividends in cash?
Right now, I'm moving it all out. Oh, one more thing. Yeah, I'm moving. My advisor at U.S. Bank is the one that sort of controls the movement of the money. I like to get out of that. But at the end of the month, any dividends that have been paid in there, he will move it out to another account that I have at U.S. Bank. And when that account gets over to, say, 15, 20,000, I'll take the balance of that money and I'll send it to an online bank, which is called Western Alliance Bank. That's currently paying about 4.25%. So I just keep earning this little bits of money on all the money. And then I know, okay, so my car insurance is paid. Now I'll go play games with my strategy trading. But we'll just do it with a smaller amount of money. And that's it. Yes?
Quick question. You mentioned AMDY and NVDY. Are they single stock real strategies?
You want to repeat those? Can you
I
hear
didn't
that?
quite get it. No, I have a little hearing issue.
So
And what about those?
are they single stock
Yes.
strategies? I.e., are they just trading, is AMDY only trading AMD, NVDY only trading the NVIDIA?
I assume so because they pegged it to the symbol.
So what they peg it to the symbol, but what they're doing a lot of the times are they're buying deep in the money calls and they're writing calls against it. So they're basically doing something like the wheel strategy with all options. It's a really amazing vehicle that they're doing. And the one that he mentioned there, I don't know if anybody saw it, but I'm moving more and more money into PHK. It pays a 1% dividend per month. And it's a nice income stream. Very, very nice income stream.
How is the price stability?
Can't hear you.
How is the price stability of PHK?
Pretty good. It's pretty flat. And
Pretty
right
flat.
now, it's actually low as where I entered the last tranche. So I'm going to be entering in even more. But your JSAFE is pretty damn good, though, man. But this is another way of generating income.
I'm gathering other ideas to.
Yeah. All right.
And it'd be nice if people do get into this, you found out more information, if you could sort of feed it through the system here and we could all take advantage of it. I would like to hear it.
Yeah.
So anyway, that's what I have.
Great.
Okay,
Thanks.